Good morning, everyone. My name is Hoyoon. I am an attorney with Seward and Kissel based in New York. I primarily focus my practice on banking and finance transactions in the shipping industry, usually on the lender side. I'm here today with 5 distinguished panelists joining virtually from 3 different continents. In no particular order, I have Fang Xiuzhi from Bank of Communications Financial Leasing, Bill Guo from ICBC Leasing, Evan Cohen from CIT, Evan Uhlick from DNB, and finally, Shreyas Chipalkatty of Citibank. Welcome, everyone.
Thank you.
I guess we'll just jump right into what must be on everyone's mind, COVID-19 coronavirus. This obviously is a classic black swan event that no one foresaw coming. Even maybe just about a month ago, I'm not sure if we would have spent much time talking about it, but it is now having a major impact on every aspect of our lives, both professionally and personally. So I'll start with a general question. What impact is the coronavirus situation having on your current deals? From my personal perspectives, for the deals that are near the finish line, there seems to be a mad rush to get them done for the fear that the window of opportunities may close, but the deals that are just getting started are slowing down quite a bit. Maybe we'll begin on the bank side. Mr. Cohen, would you have a view on this?
Sure, thanks, Hoyoon. I wouldn't call it a mad rush. So for the deals that are in process, we continue as usual. So we're closing and working on half a dozen deals now without any interruption to that. And there's another half a dozen transactions that we've been working on and will continue to process. It is fair to say, or fair to expect, that it will slow down a bit at the banks because we're all occupied with other business, coronavirus related and systematic related. But so far continuing to do business as usual.
Mr. Uhlick, what's your view on this?
Yeah, I take a decidedly other position than Evan Cohen here. We are in a very big rush to close out a lot of our existing pipeline for a couple of reasons. Number one, funding cost. If you're not a dollar-denominated, dollar-long bank, funding costs for the international bank community have shot up in very material ways. We've seen significant weakness in kind of the wholesale funding markets for non-dollar denominated currencies. So anything that is not nailed down through a commitment letter or loan agreement needs to be reconsidered from an economics perspective. The second is, of course, just the natural challenges of everyone working from home. And a lot of our treasury, operational, client services and payment people now being in remote locations. I think over time, we have to see the sustainability of that. We're in brave new waters here, both from a global macroeconomic perspective, financial community perspective. So we are very much in a rush to lock in our existing pipeline and close out deals. We've also seen for banks that maybe are not as far along in the process, many syndicate partners pulling out of different transactions. As folks know on this panel, time kills deals, and we are in a hurry to lock in a lot of our syndicated facilities. For the future pipeline, I think there's an overall pause going on right now as the world assesses the impact of this terrible situation. I think if you absolutely need money, yes, you need to go out and find money right now. But if you are financing borrowers that are in a good financial position, I think most people are taking the pause and assessing the situation.
Mr. Chipalkatty, what's Citibank's view on this?
Thanks, Hoyoon. For Citi as a global bank, we have obviously over 1,000 clients who are now looking at what this COVID impact is going to be for them. And as you might have seen from the newspapers, the initial rush was to get as much liquidity as possible under their belts before others joined the queue. So there was obviously the airline industry and the cruise industry. And then later, slightly later, with the occurrences in the energy market with Saudi and Russia, the energy sector took a little bit of a wobble. So we've had a number of things happening in the last few weeks that have focused the bank's attention on generating liquidity for clients. And also as a large global bank, for us, it's very important that we continue to support our clients with cash management, trade finance, and other foreign exchange services, for example, all of which have been affected by the factors that Evan just mentioned. And it is extremely important for us that base of clients continues to feel our impact in a positive way around the world. Now, for shipping in particular, yes, we are heavily weighted towards asset finance. And as my colleague said, there is a rush to close deals. But the reality is, I think this problem is with us to stay for a bit longer than most people anticipate. I think we're probably looking at maybe another year and a half. By the time the whole supply chain of the world sort of gets unjammed because of people issues, because of working capital issues, liquidity issues. So I think we need to prepare for the long haul for this, but that's how we see it for now.
Going back to what Mr. Uhlick said, given that the macro level risk profile has now changed, is pricing going to be affected for your existing deals or for the new deals that are in the pipeline? Evan, I don't know if you have a response.
You'll have to distinguish which Evan.
Yeah, we're fortunate to have two Evans on the panel today.
We'll start with Mr. Uhlick.
I think, as I mentioned before, we've seen a real spike in funding costs for non-dollar denominated financial institutions. There's tremendous pressure right now with investors selling their safe positions. And if you look at a lot of the funding costs, they've shot up to double-digit proportions. That incremental cost has to be transmitted through at some point within the funding cycle. It's not happening immediately, but we've seen a real spike. Very fortunately, we have not had to go to the market and we're not paying up for deposits, but this is going to be a factor. I think the broader question, Hoyoon, is not about is pricing going to go up, but it's I think the question we're focusing more and more on within maritime finance, which is what are the sources of capital going to be? This is another androgynous shock to the total sources of maritime finance capital. So I think, yes, in the main, directionally, pricing is going to go up, but it's also going to have a broader impact on total liquidity for the space.
So on that, maybe we switch to the leasing side, which has been a major source of liquidity in the shipping industry. Mr. Fang from BOCOM, how's the mood in China? Are things back to normal now there?
Yes. China takes some measurements very earlier, and after China Lunar New Year, some people stay at home, some people came to office, but now almost all people come back, resume works. Even just today, even Hubei province announced the travel restrictions will be lifted early of next month. And so now in China, everything come back, resume normal, and including CPS. Yeah.
Mr. Guo from ICBC, are you seeing reduced activities because of the current situation?
Yeah, we are slightly different, compared with the Fang and the Uhlick Leasing. I'm located in the Beijing, still the capital of the China. The station right now in Beijing is slightly different because there are more, I would say, the cases happening right now in Beijing these days compared with the rest city in China. The major reason because of the passengers from overseas, they all come back, especially these Chinese students studying in the US, studying in the UK, in Europe. They may be worried about the coronavirus, and in those countries, they feel like safer to come back to China. Of course, bringing in the more cases in Beijing. Right now, we're not 100% fully recovered right now in Beijing. For example, like Financial Street in Beijing, we only allowed 50% and employees staying in the office, another 50% employee working at home. So, we try to work in this kind of scheme to ensure the whole Financial Street and will be keeping it safe. And I think that's the fundamental and the requirement from the central government. And one more thing about the China Leasing House, and in the past 10 years, the China Leasing House not only actively in the shipping finance, but also very actively in the aviation finance. So right now, maybe this panel session we're talking about the shipping finance, but unfortunately we have also to think about the aviation finance as well, because it also impact the liquidity, also the whole financial structure of this leasing company in China, or maybe other leasing company also in the rest of the world. Because at least 1/3 of income come from the aviation side. So overall, I would say this coronavirus, and I recall we have this kind of panel, also organized by the Capital Link back to maybe 2 months ago. So only Fang and myself stay in the home, and the rest of people still can really go to the panel, have this kind of discussion. But then 2 months later, unfortunately, everyone have to stay at home, use this an online channel to talk to each other. So from our perspective, like the rest of the participants said about that, one thing we are not sure is about when this kind of coronavirus could be finished and could be banned in the globally. So that would be impact hold the next step. So right now the Chinese shipyard started working, but it's they only can working on the existing ordering. But for the new booking and the new ordering, had to be delayed or maybe had to be postponed. So this would be worried about the whole supply chain whole globally. So that's something would be impact our business as well.
So are shipyards generally open and working in full operations? Obviously, workers that are working there, there are big health risks. I don't know if you have a view on how the shipyards are dealing with the current situation. Mr. Guo, I don't know if you have a response.
Okay. For example, like we have the few shipyard, we have the few ships that been delayed due to the shipyard issue, because all the new neighbors and the laborers come back, they have to at least 2 weeks had to be stay at the hotel, for this isolation as required by the Chinese government. So this will be in the significantly reduced, I would say, the labor force to supply to the shipyard. Like Fang said about, situation become, right now become like a normal. So the shipyard had to be the more and the power force to speed up, like say the new building process. But unfortunately, it had been delayed in the past 2 months, which means the Chinese and the shipyard had to speed up a little bit and to catch up what they lost. And that's the overall situation. Unfortunately, and we are in Beijing, we haven't had the chance really go to the shipyards and in China. So right now we only can use the telephone or so this kind of online channel to talk with each other. But based on my understanding, also my communication, the shipyard gradually come back. So and they are fully, almost 100% full speed, as they are scheduled before. But again, one thing I already mentioned, they're only working on the existing ordering. For the new ordering, unfortunately, don't have right now on hand. So for them, then not that very hurry to finish all this order, on hand ordering, the existing ordering right now. So that's the current situation for the Chinese shipyard. I don't know, Mr. Fang, have any further comment?
Yes. Yes. Now you can see one more shipyards have some naming ceremony, steel cutting ceremony, and more and more workers come back from home to shipyards now. You know, formerly many workers is from Hubei province, and now they are allowed to come back. So that means formerly about 1.5 months ago, shipyards was opening, but not too many people, workers come back. But now maybe already 80% is in place. But that's enough. Just like Mr. Guo just said, there are not too many new building orders. They just working on existing new building orders. So the workers is enough. Yeah.
So what about defaults under your existing financing deals? Are you starting to see borrowers get into trouble already? Are you seeing more waiver requests for covenant breach as a result of the recent events? We'll start with maybe Citibank, Mr. Chipalkatty.
Yes, look, I don't think anybody is in trouble just yet in the shipping community. I think if we leave cruise aside, the cruise has had well-publicized issues, but I don't think anybody in what we would call traditional shipping has evidenced any real stress just yet. I think people are preparing. People are projecting the next 18 months. They're looking at what could potentially go wrong. And obviously, in those sectors where there are long-term contracts, people are reviewing the contracts. Where there are spot market exposures, certainly they're more concerned. But things like terminals, for example, we are looking at various distress scenarios where if there is a fall off in world trade along the lines of 2009, that was an 18% fall in world trade, and the condition of the shipping market in those days was very different. People were weaker. Now people have higher liquidity levels. The markets have consolidated. Fuel costs are significantly lower, and of course the overall pie is much bigger. So I think it's slightly different for shipping this time. But quite honestly, and I think this is no surprise, if this situation continues for longer than 3 months, I think we have a significant problem at all layers of the shipping business.
What about you, Mr. Cohen? Is any of your borrowers getting into trouble already?
No, similar to Citibank, at CIT, we have not had any waiver requests or borrowers that have gotten into trouble in the shipping space. Working with them, working with our 30 clients proactively to see where they might get into trouble or some rough spots if this goes on for an extended period of time. It's also been helpful that our focus has always been on the core sectors of tankers, container ships, and bulk carriers, so have been somewhat insulated so far from the impact cruise and offshore has felt. But so far, so good.
What about on the leasing side? Mr. Fang from Bocom, are you seeing more waiver requests?
No, so far we haven't seen any such kind of request. Yeah, so far so good. Because we have about 40% is container ships and 30% for tankers and only 10% for dry bulks, and maybe just 2% for cruise. So far, we believe the impact is temporary and only just 1 month, 2 months, and maybe there will be serious impact for next 2 or 3 months. But generally, to shipping industry is temporary impact, not a long term. And then after the virus, after the pandemic be finished, then the whole shipping activity maybe will a little bit slow down, but generally it will be fine. Yeah.
So looking toward the future, it seems like at least a few of you on this panel expect there to be lingering effects on lending activities in general because of this coronavirus situation. Do we think there's any chance that we're going to have a V-shaped, recovery in the second half in terms of general economic activities, essentially fitting into 12 months worth of activities in 6 months from June to December, and everything is going to be just fine? Mr. Uhlick, would you have a view?
When people talk about this potential for V-shaped recoveries, the underlying assumption is that the global population, the governments, the medical community will in very short order be able to get a definitive handle on this terrible virus, and that within a 2 to 3 month period, everything is going to go back to normal. I think that's the underlying assumption for a V-shaped recovery. My own personal view is that this is going to last a heck of a lot longer than 2 to 3 months. I think we will see the apex potentially of the total infections, maybe in that period of time. But at the current growth rates, I think this terrible situation has the potential to really drag out through 2020. Shreyas very astutely brought up the kind of comp that we have to the global financial crisis, which I thought is a very good and thoughtful comparison. And, there was that whole restocking trade of 2009 in the second half, where the whole world basically restocked. You saw the container ships start moving again. It was actually quite a breathtaking uplift within the economic activity. And I think ultimately that has to happen, just given the snap back within economic activity. Right now, if you're following the government's instructions, you should be effectively living like a hermit, eating pasta and not going outside, maybe only to walk your dog. At a certain point, there is going to be a pent-up demand for people to spend money on capital goods, take vacations, and kind of, return to normalized economic activity. My only question is, what is the underlying assumption? And I do hope it's shorter rather than longer.
Mr. Good, would you have a view on this from an Asian perspective?
Yeah, just back to your first question. So we do receive some kind of request about the waiver, and but we haven't been really deep the discussion yet. So my personally worry about maybe if the situation could last 2 or 3 months more, and worry about those shipping companies, the cash flow, also their equity situation, because in the past, in the next few months, they wouldn't receive any of them, in cash. So that generates some problem for their internal problem. So worry about they maybe have some kind of potential in the default to pay back to the decent salary, also the OPEX, even for the banks and the interest. So that's we already start to worry about this situation. And I would say, for the V-shape, and those people talk about China, could be in the new infrastructure and the plan, because people recall the 2000 and 2008. And when the financial crisis starts, so Chinese government released this and full trading, and there may be and then this kind of plan to really save, I would say, the shipping industry temporarily. And so people also hope maybe, and this time Chinese government also released some new, and say, in the infrastructure and the planning. People talk about some maybe and even 20 trillion, maybe even 5 times bigger compared to 2008. But this just a rumor, hasn't been really confirmed yet. But in my opinion, maybe, and if really something happened from China's side, so for example, like for the dry bulk, for the tanker side, could be saved. Really help, because China still be one of the largest importer for these raw materials, including like ore stone and the oil and these kind of materials. So if the China government really take those kind of action, it really help to save this and the dry bulk, and also tanker business. For the container, right now is because China more for the export market. It really depends on the U.S. also the European market when it really be fully recovered. So China's, because right now China factory already fully, I would say, fully running, so they could produce the commodity. So it depends on the buyer side. So in general, so we are live the positive and for the second half this year for the shipping market, put this way.
I have so many more questions on this topic, and we can probably keep going for another hour or two, but perhaps we switch to another topic. Leaving aside the effects of this coronavirus situation, maybe we talk a little bit about the availability of financing and shipping. And Mr. Cohen and Mr. Uhlick had mentioned before, the question really is where the liquidity is going to come from for the shipping industry. So I'm sure you've been asked this question a lot on these types of panels. What does a vessel owner need to demonstrate to your institution to get financing? Is it still just about cash flow prospects with a long-term charter? If, for example, I have a vessel that's only 40% levered, can I refinance that vessel with your institution without any long-term charter attached? We'll start with you, Mr. Chipalkatty, Citibank.
Thank you, Mr. Nam. Fundamental principles remain unchanged: asset quality, cash flow quality, and of course, I think becoming more and more important in situations like this, the character of who you're dealing with. These are things that become super important. Nothing has changed. I mean, we still look at the overall capital structure of the borrower, the sensible behavior that may have been evidenced in the past, and our own experience with the client, because we don't typically take on new clients. We work with a very limited set of clients that we've dealt with over many, many years. And we study effectively how that has worked out. So every new deal is really a layering on, you might say, of our past experiences plus the features of the new transaction. But I think that those are fundamental principles that I think all of us employ.
Mr. Cohen?
No, fully agree. We start with the focus will continue to be the asset type, the quality and skill of the owner and operator, the cash flow. We will even more be looking at the break-even levels and how they're supported. And you're right, you allude to, and you say specifically, long-term charter becomes more important. It's not exclusive. That's it. So staying focused on those same principles.
Mr. Uhlick, I guess to add to my earlier question, are there any particular sectors within shipping you are focused on or avoiding? Would you lend to a cruise company, for example?
We do lend to cruise companies, and I think that's a sector we're watching quite closely right now. Shreyas used a very good expression. I think Evan Cohen backed it up. Nothing has really changed from the tried and true principles of bank underwriting. These buzzwords of character, cash flow, asset, sponsor, nothing has really changed here. What has changed is the overall origination dynamics from a cash flow and market perspective, and potentially also the response of the owner. I will just maybe take the opportunity to say that it's disappointing, but understandable, that the whole ESG conversation has been a little sidelined at present due to the nature and breadth of the crisis. I think certainly at the end of 2019, there was really a lot of momentum around ESG and wrapping these ESG principles into banks' origination considerations. And I think you found a lot more traction with the Poseidon principles, and also how banks are working with their borrowers to overall lower the carbon footprint. Again, quite understandably, those type of considerations have been reduced right now as we go through stress testing, liquidity analysis, and trying to understand the depth of this crisis. But I will very much say that DNB looks for management and owners that abide by these principles and understand the direction of the energy transition.
Just on the topic of ESG, do you think, Mr. Uhlick, do you see investor appetite in these types of loans? Again, leaving aside the current situation, are investors really interested in these types of environmental, social, governance-oriented loans that are going to be good for the society at large, but perhaps not so great for yields perspectives?
I'm not entirely sure I agree with all the statements that you made there. I think that ESG related transactions or ESG linked transactions provide a good bridge between financing worthy companies with a responsible moral compass and also giving investors exposure to the energy transition and supporting a changing world. So I think on DNB's behalf, I think we're quite bullish towards kind of a higher proportion of ESG or ESG linked lending or origination. I think investors are extremely focused on this segment, certainly more so vocally in Europe and particularly Northern Europe. And the way that I describe the situation in the US and from a US capital markets perspective is you really see it from a capital allocation perspective. It is, no coincidence as we ended 2019, some of the least invested segments are also the brownest or the dirtiest segments. We had a investor presentation and the cover of it was the Jolly Green Giant. And if you think about the hot segments within 2019, they were large and they had green influences. So no, I very much think that this ESG focus is here to stay. We need to get out of the burning building first. And I think after that, people will return to these principles.
What's your view, Mr. Chipalkatty, on this ESG concept? As Mr. Uhlick says, because we're potentially facing a recession here, and there's a perhaps a little bit more urgent issue to deal with. Is this all going to be out the door for now, or do you think it's here to stay? Is this the way of the future, given the current future generations focus on these types of issues?
Thank you, Mr. Nam. And I agree fully with Mr. Uhlick. I think he's made all the salient points. I think we need to get out of the burning building, as he put it, and then get back to the normal, whatever normal means going forward, course of business. But I just want to make an ironic observation that this particular crisis has done more for the environment, as far as I can tell from public sources and what people have been saying, that pollution, overall consumption, plastic generation, all of these things have fallen significantly, and it's an ironic sort of side effect of this tragic situation. But I do agree that overall it is something that we need to continue to force in terms of change, both with carrot and stick. I think I agree with Mr. Uhlick that overall interest will continue and that momentum will continue to build, because it simply is something we have to do, and we are the people who can make that change. We are the ones who can direct capital in a responsible way, and we should be doing it. It is important that we put it aside, or at least work on it maybe a little bit less for now, but I think we will come back in force.
Mr. Fang from BOCOM, would you have a view on ESG-focused financings?
Yes, we generally support ESG projects. And also we can get green loan, green project loans, project financing cost rates will be lower. So our customers finally can get better prices for ESG projects. Yeah.
Maybe we switch to another topic for a little bit. As we all know, LIBOR is going to disappear in about a year or so. What impact do you think LIBOR's disappearance will have on shipping loans, if anything? We'll start on the bank side. Mr. Cohen, would you have a view?
Notwithstanding the current coronavirus crisis, I think there was going to be a normal transition. I think your firm in particular was working on some of those transitions. So there is a base cost of funding, whether it's LIBOR or another definition, that was already in the works. So I think that transition will happen without too much drama.
I think one of the concerns, at least on the owner side, is that this is going to involve a lot of paperwork, and potentially there's going to be some amount of cost involved, which for the most part, under typical loan documentation, would be payable by the borrower. Have you had any borrower voicing these kinds of concerns? They're worried that this is going to add to their expenditures.
Not yet, no. And it's been somewhat superseded by events. So if it was coming in the next few months, that's been delayed as well.
Mr. Uhlick, have you had any concerns from any of your borrowers regarding LIBOR?
I think much like Mr. Cohen just said, this, at least for DNB, has not been a quote unquote hot topic. I think we all know that it's coming down the road, but I think it hasn't really been something that we've dug into institutionally, and that's probably been pushed back. It raises a whole host of questions, however, and I do think it's not going to be a straight and easy path. From an operations and administration perspective, I think there will be issues. We've also, over the last couple of weeks, been extremely active on our derivative desks. There's been a lot of good interest rate hedging activity going on. And just a very interesting question is, if you hedge LIBOR for the next 5 years and you move over to SOFR, what exactly happens with those hedges? And how are those hedges converted to SOFR? This is all very much uncharted waters. I think technically there are answers for them, but we haven't seen that play out in practice yet.
Yeah, I think all of those documents will eventually need to be amended, as you say. You start with LIBOR, and now LIBOR is not available, and all we have is SOFR, which is different from LIBOR. How are we going to reconcile those differences? I think at the end of the day, whether it's LSTA or ARC, some of these regulatory groups or industry groups, they'll have to come up with mechanisms by which these kinds of adjustments are going to be made industry-wide, which is going to involve some amount of paperwork. Speaking of SOFR, this is probably the likely replacement to LIBOR on the US dollar side, and at least in other industries, there's starting to be a talk about using SOFR as the basis for interest rate calculations. Would any of the institutions on this panel consider such a loan based on SOFR before it becomes much more prevalent in the industry? Maybe Citibank, Mr. Chipalkatty?
I don't really have an opinion on this. I think from a more sort of client focused, if it makes sense, we'll do it. If it doesn't, we have multiple lending entities across the world and multiple structures. I think getting into anything, really, the point that Mr. Uhlick made, getting into anything at this stage is really about preparing for what the implications could be for unwinding things and future costs rather than what it looks like at the moment. So whatever happens, I think we'll take a deliberate and sensible step towards it, if it makes sense.
Thank you. Unfortunately, I think that's about all the time we have. Thank you to all the panelists for their great insights. If anybody watching this has any questions, please feel free to type them away. And I hope everyone has a great rest of the conference. Thank you.
Thank you, everyone.
Thank you, Mr. Tam. Thank you.
Thank you.
Thank you.
Okay, bye, everyone.
Bye.
Bye.